So yes, Cannara Biotech Inc. Love LOVE on the TSX Venture, currently trading at a price of 68 cents and has about a $62 million market cap. So they're a vertically integrated producer of cannabis and cannabis or derivative products for the Canadian markets. The company owns two facilities based in Quebec, spanning over 1.6 million square feet. And they have three flagship in-house brands, which is Tribal, Nugs, and Orchid CBD. One thing that I find that you see with a lot of these cannabis companies is they will talk about, their brands. Realistically, cannabis at the end of the day is a commodity. So I would keep that in mind. And as well, the company currently serves consumers in Quebec, Ontario, Saskatchewan, Alberta, British Columbia, and they recently received approval for Manitoba in March of 2024 and is expected to be selling by Q3 of 2024, which is what they're in right now. And again, they're just selling to dispensaries. They don't have their own dispensaries, from my understanding. So looking at the stock chart here, the share price is down about 18% year to date. But it is important to note, the one thing that I wanted to bring up here is that the company did a 10-for-1 share consolidation in January of 2023, reducing its share count from about 877 million shares outstanding to about 87.7 million shares. And I believe they're sitting right around the 90 million shares outstanding. I don't think that they've actually done a placement since they did the share consolidation. But that's just something to keep an eye on and to note. And as mentioned, the company has two facilities in Quebec, the Farnham facility with 170,000 square feet of cultivation room, and the Valley Field facility, which they acquired in 2021 from the Green Organic Dutchman, or T-God as some people know it, as for about $27 million, which has the potential to get the company up to 100,000 kilograms of cannabis production through the years as it expands this facility. So as the picture I have on the screen shows, which is from the company's Q2 2024 slide deck, as of January 2024, the company has annual run rate capacity of about 33,500 kilograms of cannabis and is looking to enter fiscal year 2025 with production capacity of about 45,000 kilograms. Now, moving to the financials, the important part. So this is for Q2 of 2024. Revenue increased 51% year over year. Adjusted EBITDA was up about 8.7% to 3.5 million. And net income was a loss of about 3.4 million or 4 cents per share, compared to a loss of about 600,000 or 1 cent per share in Q2 of 2023. Now, the decrease was primarily due to a decline in operating income, as SG&A expenses were up, as well as net finance expense was also up to about 1.5 million, as the company needs to service its debt. And looking at this debt, or looking at the balance sheet, the company has cash of about 3.1 million and debt and leases of about 49.5 million, providing net debt of approximately 46.4 million and a trailing net debt to EBITDA multiple of about 2.65 times. Now, I should also mention that the company sold a parcel of land for about 2.1 million in April of 2024, which isn't accounted for in my numbers shown here. And the company is paying a weighted average interest rate of about 8.8% on its debt. So generally speaking, the net debt to EBITDA multiple is getting to the higher end of where we would like to see it. But I will say at least the company is cash flowing to some degree. Now, looking at the valuations, Cannara trades with a trailing price to earnings multiple of about 11 times, an EV to adjusted EBITDA of about 6 times, and a negative price to free cash flow multiple, given trailing free cash flow was a loss of 194,000. So to conclude, I really think that Cannara is an interesting business, and I have reviewed the company a few times when we've done our CDR sweeps. But even going back to 2023 and looking at my notes from when I did come across the company, the company still had net debt of over 30 million at that time. The company does have a good runway of growth through expanding the Valleyfield facility and with entering new markets such as Manitoba. And they also have touted that they are gaining more market share in some of their markets, such as Alberta. Now, the 10-for-1 share consolidation has tightened the share count, but it would be great to see the company refrain from further diluting shareholders. Again, I haven't seen it. They have been buying back a very, very small amount of shares, which, I mean, is a positive, I guess. But again, it's very, very small. But yes, it would be nice to see the company not have to, serially dilute shareholders and then potentially have to do a consolidation again, like we've seen, many companies do before. Now, the business is fundamentally strong, I would say, with good revenue growth and a history of profitability and cash flow, albeit not completely consistent. It does trade with reasonable multiples of about 11 times earnings and 6 times adjusted EBITDA. However, debt may be a bit of a concern given the high interest rate, and to expand the Valleyfield facility further, they will likely need more capital. So the question comes, do they raise more debt, or will future cash flow suffice, or will they potentially have to dilute shareholders for expansion plans? Now, for companies in the cannabis space, I think that it screens pretty decent, but I would like it more if the balance sheet was in a net cash position.
Yeah, it's a good summary. I mean, we'll continue to look at the cannabis sector. There was a massive oversupply. There was far too much capital came into the sector, chasing less demand than originally anticipated. This is just generally speaking. Capital was easy, and this kind of created poorly run companies. As the weak pretenders kind of die out, the market flushes the entire segment. Over the next couple of years, there may be an opportunity. We may look at some businesses. Cannara has some promise. I'd love to see, Cannara find a Cannara with a cash-rich balance sheet that is profitable. That would be what's kind of missing from our equation here. And then, just look at how the supply situation is. When a sector gets flushed, there can be some, opportunities for some stronger players that emerge when everybody just says, I don't want to look at anything in this segment, because there will be some people, there is demand. There will be some people that make money in here at some point. But whether that happens this year, next year, or still 10 years from now, I'm not sure. But the one fly in the ointment with Cannara right now kind of is the debt situation for a company of its size. If you had 20 million in cash and it traded at those valuations, and then you'd have kind of a margin of safety that you might, you could say, okay, this might be an interesting company. So we're on the lookout for a business kind of that matches some of the growth and has some free cash flow, and then, probably has a better balance sheet.
Yeah, and that would be an area, because again, this is just a free podcast. I did a quick dive into it, but that would be an area of further research, is kind of
we do for clients.
Well, exactly, that we would do for clients. And again, I'm not going to do it right here, but just taking a look to see, what kind of CapEx they're expecting for these growth plans. Is it a couple million? Are they going to have to raise, 20 million? Again, I don't know. Just from my quick in-depth research. But again, that is something that, we will dig into for our clients, of course.
Yeah.
Just one. Just one last thing. They may get a bit of relief soon because their interest rate is variable. They paid 8.75%, which it's not absurd for a company like this to pay that much right now. That's not that bad. Many of these smaller companies are riskier.
No, to be honest, I've seen higher.
That's pretty good. Yeah, you'll see
I've seen 14%,
for quite a few. And some of the very risky ones I've seen nearly credit card rate levels of interest.
Yeah.
But even then, you would expect that to come down, because that is just based on a prime rate. So they might get a bit of relief, which then they can actually use that additional interest rate room to either pay off debt, which would be nice to see, or obviously fund additional projects as well.
So those are questions we've had. Are you is free cash flow not going for expansion now? Are you going to have to pay down debt, or do you raise equity again? And this company was a serial issuer of capital, and it's you're robbing Peter to pay Paul. It's just it's. I think for us to start to get involved in a company like this, or start to look at maybe having a recommendation, it would have to have a flip on the debt. And that's not going to happen anytime soon without some dilution. So, I mean, there's some companies that we could look at in this sector. This is one of them that we could look at. It's not one that we'd have a recommendation on at this point until there was something different either in this company. But I think we'd look elsewhere if we wanted to participate at this given time.